Well, hello, everybody. Woo, this is the final day. Did you have a good time? Yay. Love it. Love seeing all of you. And so happy that you had a good time. You know, we had an extraordinary 3 days. We learned a lot. We got a chance to catch up with old friends and some new friends, too. And we also got a chance to share knowledge and to hear about the priorities that are so important to this industry. We also heard about and focused on inclusion. And we turned that mirror inward as well. Heard some powerful stories about what we needed to do more of, not only as it relates to serving our communities, but even serving our members, our own members, and making sure that they're feeling included and that they're part of this industry. So I was just so thrilled and so touched to hear so many of these stories and to get a chance to talk to so many of you. Didn't get a chance to talk to everybody, but don't worry, it's next year, 2023, Washington, D.C. We'll do it again. So, are you ready for this final plenary session of the sold-out conference of Opportunity Finance Network? Because I'm ready. And we've got some real special treats for you this afternoon. To kick us off this afternoon, it's my great pleasure to welcome the U.S. Treasury Department's Assistant Secretary for Financial Institutions, Graham Steele. Throughout his career, Graham Steele has been a staunch promoter of good governance and a more accountable capitalism, working at the highest levels of law and policy in Washington, D.C. His experience includes roles at Stanford Business School and the Federal Reserve Bank of San Francisco. Graham was formerly the Minority Chief Counsel for the United States Senate Committee on Banking, Housing, and Urban Affairs, and was Policy Counsel at Public Citizens Congress Watch. We are so thankful for Graham's support and for advancing a policy and regulatory framework that meets the needs of our industry and the communities that we serve and support. Please welcome to the stage Assistant Secretary Graham Steele. Graham?
Let me try to make sure that everyone can hear me and this is at the right level. Hello. I will try to get through this quickly because I am in the way of you hearing from the brilliant Heather McGee. So I'll try to keep my remarks brief. I want to start by thanking Donna, who was a great leader when she was at the Treasury Department running the CDFI fund and a great public servant, and is continuing the work now in the field as a leader in the CDFI industry. So thank you so much, Donna, and thank you all for having me. It is great to see so many friendly faces here today. So, as Donna mentioned, my name is Graham Steele, and I'm the Assistant Secretary for Financial Institutions at the Treasury Department. I will begin by telling you what that means, and then I'll give you an overview of the hard work that has been happening at Treasury and in the CDFI fund specifically, investing tens of billions of dollars in CDFIs and MDIs in furtherance of having a equitable recovery and, more importantly, sustainable economic growth. I'm going to draw some connections then about those programs and what that means in the administration's vision for how we want to do community economic development, and then I'll conclude by saying some of the things that come next. But really, ultimately, in the years to come, I want to hear from you all what more we can be doing, what those next steps are. So I'll sketch out a little bit of how we're thinking about what we want to do, but really this is the beginning of a conversation with you all about where we can be helpful and where we move after some of the programs that we've set up over the last few years. So what is the Assistant Secretary for Financial Institutions? Well, I have 4 offices. One is the Office of Financial Institutions Policy, which is basically our in-house think tank for policy around banks and credit unions. They recently wrote a report about cryptocurrency and consumer investor protections in the cryptocurrency space. We are working on a report on financial technology or fintech and what they are doing to serve consumers. So that's what they do. They formulate policy around traditional banks and credit unions. We have a federal insurance office that looks at insurance markets, consumer protections in the insurance markets. Recently, we put out a proposal to request data, particularly on markets that are vulnerable from a climate perspective, to try to better understand rates that people are paying, affordability, availability, particularly in the areas that are most vulnerable from a climate perspective. I have an Office of Cybersecurity and Critical Infrastructure Protection, which is, as it says, it is responsible for ensuring that the financial sector is resilient from a cybersecurity perspective. That has taken up a lot of my time since I started with the Russia-Ukraine situation. But needless to say, it is a vital office within the department. And it covers CDFIs as well as large institutions. And then the offices that people in this room are probably most familiar with. One is the Office of Community Economic Development. That is responsible for our community development policy. It oversees the Emergency Capital Investment Program, what you all know as ESIP, the Office of Financial Stability, the Small Business Lending Fund, and of course, the CDFI Fund. Let's hear it for Jody and her team. And then there's an Office of Capital Access, which is responsible for financial issues associated with things like climate change. It has worked on the State Small Business Credit Initiative, and it's responsible for our Treasury's Office of Consumer Policy. So I started my career in financial law and policy around the 2008 financial crisis, when I first met Heather McGee. I had the pleasure of working together. I am now an anonymous mid-level bureaucrat. She is on MSNBC all the time and is a best-selling author, so I think that says a lot about our career trajectories and who's talented and who is not. But that was a consequential time, and that's when I started doing this work, both on consumer protection, financial regulation, law, and policy. And this is not 2008. But the Biden-Harris administration did take office at a time of dramatic economic crisis. But unlike the last time, the passage and timely implementation of things like the American Rescue Plan prevented the short-term shock of the pandemic from turning into a longer-term economic disaster. That was through things like the emergency assistance payments, the child tax credit, housing assistance through the Emergency Rental Assistance Program and the Homeowner Assistance Fund, $350 billion in state and local fiscal recovery funds. ARP stabilized our economy as a whole and directed resources specifically to vulnerable populations. Recent analyses, for example, of the rental assistance program have demonstrated Treasury's approach result in resources being effectively targeted to the lowest income households and communities of color in particular. But for the Biden-Harris administration, it's not enough to have achieved a historically rapid recovery from an economic crisis. While these programs were important, they were one-time responses to a once-in-a-century public health crisis. This administration realizes that the lack of economic opportunity for historically marginalized communities impedes economic progress for our nation overall, and that building a more equitable economy means investing in the potential of communities of color, low-income communities, rural areas, and other financially underserved communities. We recognize this will result in a stronger and more globally competitive U.S. economy. And while we believe community investment clearly results in economic value for the nation as a whole, it doesn't compromise the economic rigor of that analysis to also point out that we have a moral obligation to do this work, to make these investments every day. And so we view those two missions as being entirely compatible. So let me talk about the importance of you all as an industry and the work that you have done. We all know that CDFIs, MDIs, and other community development entities were essential to responding to COVID-19's economic impacts, providing financial lifelines in their communities. CDFIs and MDIs have demonstrated the capacity to reach financially underserved borrowers that, frankly, other financial institutions do not. With strong support from the Biden-Harris administration, the impact of CDFIs and MDIs has scaled dramatically. CDFIs played an essential role, and we were just talking about it backstage, in the Paycheck Protection Program, particularly the final round after this administration's rapid policy steps to make PPP more accessible through CDFIs. In June 2021, the CDFI fund also delivered $1.25 billion to 863 CDFIs through the Rapid Response Program, helping. So that will help refuel the tanks of institutions that increase their capacity to respond during the crisis through things like PPP and other programs, and served as emergency conduits to their communities. CDFIs and MDIs are important to the recovery, and will be even more important going forward for creating a pathway towards more equitable economic growth. So let's talk a little bit about some of these programs, which you are all probably well familiar with right now. We'll talk a little bit more about some of the numbers that we have dispensed throughout the last years. First, I mentioned ESIP. Treasury has made over $8.28 billion in investments in 162 community financial institutions this summer. I mentioned SSBCI, the State Small Business Credit Initiative, that is nearly $10 billion in funding to states, territories, DC, tribal governments to support small businesses. Many state SSBCI plans incorporate a role, rightly so, for CDFIs as important partners in delivering capital to small businesses. By early 2023, I promise, the CDFI fund will award approximately $1.75 billion in grants to its equitable recovery programs, for which we have received more than 650 applications. And then the last thing that I will point out is the CDFI fund's regular programs and its ongoing work. The fund has made more than $580 million in grants in 2022 through the flagship Financial Assistance Program, Bank Enterprise Award Program, the Housing Focused Capital Magnet Fund, the Small Dollar Loan Program. The CDFI fund also recently announced more than $350 million in guarantee authority under the bond guarantee programs, and will soon be announcing $5 billion more in new markets tax credits. So that's what we've done on the programmatic or on the investment side. So then, as I said, I want to talk a little bit more about our policy vision underlying all of these programs. In addition to deploying tens of billions of dollars in these partnerships, we've taken significant policy steps along the way to try to better define and safeguard the CDFI brand and the shape of community development and investment. Federal regulations and guidance people can sometimes think of as wonky or weedsy, but let me walk through a little bit of some of those key policy decisions we've made and then draw the connections between them. First, the issue of deep impact lending. In its implementation of ESIP, Treasury is providing additional credit to ESIP participants toward rate reductions for deep impact lending. That includes loans to low-income borrowers and underserved small businesses for deeply affordable housing and in persistent poverty communities. This additional credit recognizes the fact that the kind of lending that will be most impactful in achieving the statutory purposes of the program often requires more time and resources from the lender. The approach is designed to help level the playing field for the borrowers that face the greatest barriers to accessing capital and provide greater transparency into the impact of the program itself. So put another way, what we are trying to do with deep impact lending metrics is help to distinguish the ones that are doing good lending from the ones that are doing great lending. Then I mentioned the Equitable Recovery Program. CDFI Fund has established similar and well-aligned policies for ERP. The fund developed what is called ERP-eligible geographies and used those geographies to help screen applicants for eligibility and as a tool in prioritizing the applications that propose to increase lending within those ERP-eligible geographies, create new financial products and grants that support those geographies, and expand into previously unserved ERP-eligible geographies. Among the criteria we use to determine those areas are census tracts demonstrating a severe change in unemployment, severe mortality in the first year of the pandemic, and low community resilience according to the U.S. Census Bureau's Community Resilience Estimates Program. Through ERP, the fund seeks to direct resources to geographies and borrowers that were most impacted by COVID-19. Among other criteria, the CDFI fund will achieve this by prioritizing applicants with a demonstrated track record or commitments to invest in Native areas, U.S. territories, persistent poverty counties, and low and moderate income minority communities, as well as to small businesses, small farms, especially those with $100,000 in annual revenue, and to minorities that have significant unmet capital or financial services needs. By using those specific geographies and borrower categories to distinguish track records and proposed activities of our applicants, we're seeking to best implement the program's statutory purpose and to live up to the name of being an equitable recovery program. I also, clap for that if you want to. I also mentioned ESIP and ERP. Along with that, we have a proposed comment for criteria for designating a minority lending institution. We are seeking to implement this designation for CDFIs that wish to be recognized for their high levels of service and accountability to minority populations in particular, as well as to identify barriers CDFIs experience in providing access to capital. Upon implementation of the MLI designation criteria, the fund will utilize the designation for data collection and reporting and recognizes that private sector investors may find that designation useful for understanding which CDFIs have the deepest impacts in communities of color in particular. Lastly, the CDFI fund, as you probably all well know and have discussed a lot this week, is soliciting public comment regarding its certification requirements. The CDFI fund is in the progress of updating the requirements and standards for certification and has released for public review an updated application. For the first time, the fund is looking to define responsible financing guidelines for the activities of CDFIs. These clearer policy guardrails regarding certification will help protect the brand itself. And examples of responsible financing guidelines that we want to comment on are, first of all, looking at mortgage lending, and in particular, consistency with a qualified mortgage rule, and ensuring that CDFIs do not offer mortgage loan products that include negative amortization, interest-only payments, balloon payments, or carry an original maximum term longer than 30 years, charge upfront points and fees in excess of the QM limits, or fail to verify the income of the borrower. CDFI should also not offer small business loan products that do not disclose in writing the periodic payment due, the total amount to be repaid over the life of the loan, the total finance charge over the life of the loan, or the APR. Finally, applicants for CDFI certification that do not evaluate the ability to repay of its consumers or small business borrowers, or that offer loans that exceed a 36% APR cap may also be determined to be ineligible. So, taken together, these data-driven policies will more effectively direct federal funding to those institutions that best serve financially underserved communities. And they also have the potential to drive private capital. So let's just recap. For the first time, we are establishing responsible financing guidelines for CDFIs. We have proposed a definition for a minority lending institution that will help clarify which CDFIs are most focused on meeting the financial needs of minority communities. And through the deep impact lending definition in ESIP and the priorities in ERP, we've clarified types of lending and investment activities that may be particularly challenging to undertake, but produce economic opportunity in the most financially underserved communities. There's growing will in the private sector to increase access to capital and opportunity for financially underserved borrowers and communities. But a lack of alignment among investors about how to measure impact, the lack of field-wide baselines are among the factors that can make it challenging for us to scale private, socially motivated investment into CDFIs. Treasury's policies can be meaningful for private investors by providing clear and specific guideposts for shaping their own approach to achieving equitable impact and aligning with federal resources. Essentially, we can turn it over to them and say, here's a playbook, go out and invest, do lending, do investments in these institutions. The application process for ESIP and ERP have also demonstrated that a wide range of CDFIs and MDIs are able to provide data and make it possible to establish these baselines. So I'd encourage you to examine the policies carefully, engage in the numerous open comment processes we have. We recognize the need to elaborate on this framework, particularly for investors with particular interests, but we hope that policies will serve as that foundation. I will also mention climate finance as an example of an important next frontier, and I gather there's a lot of talk about this week as well, where we still have work to do to define both minimum standards, measure the difference between good and great lending, and clarify where climate action most effectively intersects with racial justice. So in addition to those policy steps, we have another effort to better coordinate federal community investment programs. In July 2022, Treasury and 5 other agencies entered into a memorandum of understanding to establish an Interagency Community Investment Committee, or ICIC, to foster collaboration and alignment in the implementation of programs that facilitate the flow of capital and the provision of financial resources into underserved communities. This committee has issued a request for information to gather input from the American people on how to improve the effectiveness and impact of federal community investment programs. So let me turn now to private sector investment and how we can leverage all these programs. Community financial institutions specialize in using federal resources and turning that into private investments, so that tens of billions of federal dollars can result in hundreds of billions of dollars in investments in communities of color and other financially underserved communities. This summer, the Vice President highlighted the formation of the Economic Opportunity Coalition, which we have some members here today, a partnership among more than 20 corporations and foundations to catalyze private investment to address disparities and accelerate inclusive economic opportunity. Treasury is collaborating with the EOC and other private sector partners to maximize the opportunity to leverage federal investments. Even as we encourage private sector investments through CDFIs and MDIs, you all in this sector are in many ways already punching above your weight, so to speak. We have to remember that large private financial institutions have their own, and non-financial institutions, frankly, have their own direct role to play, investing in communities where they may not have invested in the past. Moving toward a more equitable economy will require more meaningful change in the financial sector writ large, not just the work that you all do. So, that was a lot. Let me just stress and highlight again, we have a lot of the proposals out for comment right now, and they're not going to end up where we need them to end up without your engagement. I understand you're out there doing the work in the field, and you probably don't have time to submit comments to a request for information, but I would encourage you to look at them and do so, because the programs will only be better with your input. And so, what are the areas we would be most interested in that engagement? The first is CDFI certification. The second is the MLI, or Minority Lending Institution definition. And the third is that ICIC work about coordinating community investment programs across the government. So, we're in a transformational moment. CDFIs and MDIs have demonstrated their capacities and values. The federal government has responded with a historic investment. The private sector is poised to crowd in capital and pursue innovative approaches to investment. It will take more than CDFIs and MDIs to build a more equitable economy, but make no mistake, your work is leading the way. So I just want to close by saying that this administration sees your leadership, will remain focused on supporting the important work of community development and financial institutions as key partners in pursuing long-term equitable economic growth. So thanks for having me today. Thanks for your time. Keep up the great work.